Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get into some listener questions today. The first one is from Cara. Cara is a long-term listener and appreciates the podcast, so thanks very much, Cara. Her grandfather passed away, left $10,000 to each of her three children, and it's her responsibility to invest those monies until they reach 18, in which case then they can take over the portfolio. Her children are 15, 12 and 9, and their funds are currently sitting in the offset account, obviously Cara's offset account, until they work out what to do with the monies. Cara has a bunch of questions to ask in regards to that, and I think it's a very common situation and question, so I'm sure many listeners will be interested in the answer. So the first question is, Cara's considering opening a Vanguard Kids account. Is this a reasonable idea? Or do you have any other suggestions? I'm going to come back to that, Cara, in a second. Second question is, I understand my husband and I will be responsible for paying the tax on income earned. Is there any way to avoid it? We're in the 37% tax bracket, well, 39 including Medicare levy, really. Okay, so let me explain how sort of kids accounts work or minor accounts. There are essentially an informal trust arrangement. You know, with a family trust, you will have a trust deed, and the trust deed is all the rules associated with the trust. And a trust is really just an agreement to hold assets on behalf of the beneficiaries. And a trust deed can include, whatever provisions you want it to include. But a minor's account is what's called an informal trust because there's no trust deed or anything like that. It's really just typically parents opening an account, and the beneficial owner of those monies are really the child. But because the child's not 18 yet, legally they can't open an account in their own right. And so the parent acts as an adult trustee for this informal trust. When you open a minor's account like that, like an informal trust minor's account, it will ask you to quote a TFN, tax file number. Now, you can go and apply for a tax file number in the child's name and quote that number, in which case then they will wear all the tax consequences, particularly obviously the income, dividends and so forth that come off the portfolio. Or if they don't have a tax file number, or you couldn't be bothered going to the trouble of getting one, it's not that big a deal, then the parent can quote their TFN. Now, it's important to understand that if you do apply for a TFN in the child's name, they will be taxed according to minor tax rates, which means that if it's just savings that the child has from, a gift from parent and so forth, I know, Cara, in your situation, it's an inheritance. But if it's just savings, then the first $416 that they earn is tax-free. So if you're only investing a very small amount of money, it's not that big a deal. Get a TFN in the child's name. As long as they're not going to earn more than $416, you're fine. If they earn more than $416, I think between $416 and $1,300-ish, it's taxed at 66%. So it's to disincentivize putting assets in a child's name. So if you think you're going to earn more than $416 in taxable income, then maybe quoting the child's TFN isn't the right way to go. In which case then you'd quote your own TFN. And yes, you have to wear the tax consequences of that. However, if the child is investing money as a result of an inheritance from someone that has passed, then that is regarded as exempt income, and that will be taxed at normal adult tax rates, which means they can earn up to pretty much $20,000 a year and not pay any tax. So therefore, my answer for Cara is go and apply for a tax file number in your children's name before you go and open the account. Okay, next question is, if we were to open a Vanguard Kids account, would you recommend putting the money in conservative, balanced growth or high growth? I'm inclined to put it in high growth environment and will be encouraging my children to leave the money there until they wish to purchase a property in the future. So that's right. I mean, look, you got a 15-year-old, so they're 3 years away from 18, of course. Another child's 12, so 6 years. Another child's 9 years away from, I was going to say retirement, of course, not at that age, but being able to access the money. The reality is, though, I mean, I did the same sort of thing, had a minor's trust account, invested for my sons, they turned 18 at the beginning of this year. The shares are now in an account in their name, of course. So, I don't have to pay any more tax on that income. But the reality is, they're probably not going to access the money for another sort of 4 to 5 years, I would have thought, to go and buy a property. So even the 15-year-old may be still 8+ years away. So I think high growth is the right way to go. Given the market is so volatile at the moment, I know we're not talking about huge, in relative terms, huge amounts of money, but maybe what I would do is invest, the $10,000, maybe $2,500 each. So over 4 tranches, a couple of months apart, just to kind of spread that timing risk. And if the market, if there's a lot of volatility and the market drops, maybe you invest more at that time. But I think high growth is the right approach. Vanguard now has a 100% growth diversified option. So I'd probably even choose that one. So no bonds, if you like. And you could do that in Vanguard, or you could do it in a different environment. BetaShares has a share trading account. I don't know if they can do it in miners' names, but they do have one. And you could use a diversified fund with BetaShares as well. But they're all pretty similar. Vanguard will work out well for you. But great question, Cara. And I wanted to take a bit of time answering it just to delineate between, hey, if we've got savings that a parent has given a child and we're investing, that's different from inheritance from a taxation perspective. And therefore, that's why you might want to get a TFN for them. Okay, next question is from Shawn. Thanks for the high quality podcast. You're welcome, Shawn. Shawn asks, my question is about investing directly in international real estate and when it makes sense to do so. What are your thoughts on the potential opportunities around the world in all the available sectors and the risks associated with it? Well, good question, Shawn. When the GFC hit, back in 07, 08, or people that were around at that time might remember that the US housing market hit the skids and property prices started to drop significantly. And what you had was there was a bunch of different businesses here in Australia selling US property. And they said, well, you can go and buy this property, go and buy a house for 50 grand or something like that. And we think, it's intrinsically undervalued and, you're off to the races. There's so much complexity with owning property, particularly in the US, because you've got federal and state-based taxes, and they've really tightened up non-resident taxes as well. I mean, just wouldn't go near it. If you think about other jurisdictions, say Western Europe, for instance, you've got typically, again, really high taxes associated with non-residents buying into the market and sometimes restrictions not allowing them to do so. I'm not an expert in that market, but, I've looked into it. I'm not sure about the UK and any complexities there. And then you've got the foreign exchange risk. You've got, the ability to borrow, will going to be dependent on the banking system in the country that you're doing that in. And then you've got to understand the market. I mean, I just wouldn't do it. I wouldn't go anywhere near it. If you want exposure to property, global property, I would invest in a real estate investment trust. Vanguard and VanEck have two pretty good global property index funds. Both offered hedge versions as well to hedge the currency risk out. And then you're going to get well diversified exposure to property. But in terms of direct property, no, I wouldn't bother with it, Shawn. I think Australia's a great place to invest in direct property. And I'm not really sure there's better markets than Australia, to be honest, particularly with negative gearing. Okay, next question is from Tom. I've got 2 questions. The first, at the request of my wife, who's also listened to me harp on about the value of your podcast. Why do you do it? You have no ads and you do not actively promote your business. Are you simply a benevolent financial wizard? I'm going to go home and tell my wife I'm a financial wizard. I was going to say, I think she might be impressed. I'm positive she won't be. Anyway, well, Tom, why do I do it? Because there's just too much going on inside my head and I need to get it out. I think that's really all it is. I think I'm just generally intellectually curious and, I come across different things every day and different problems, and I'll look at sort of investing in property, investing in shares, super, tax planning. I look at all those things and think about them not only for my clients, but also for myself. And then I tend to ask myself questions about it. What about this? Is it worth owning a residential property in a company name if I'm a POYG individual. Maybe you could do this and do that. And then I just sort of think about it. And so the blog that I've been writing for a long time, more than 20 years, and I've been writing it weekly for probably the last 10 years, I suspect, is really just a way to get all the noise out of my head onto paper. And then I realized that not only does it help me in terms of formulating advice in our business, so, if there's a particular thing going on in the market, for example, like last week's episode, I talked about, the large cap stocks in Australia. Well, quite often we're looking at these stocks. It's a good way for me to do that analysis because I know I'm going to have to give advice on it. And so it's one way to do that. And then the other way just to kind of get it out. And then I started the podcast just as another way for people to consume the blog. So if they didn't want to sit down and read a blog on the web, at least they could listen to my boring voice talking about it. And that was the idea. And so I think I would like to do it, continue doing it for as long as I make sense, assuming I make sense today. And, because I get a lot of value from it. And if I didn't do that, I think I'd go mad. But I'm not sure anyone else is interested in the answer to that question, but thanks for asking anyway. Well, sorry, thanks for Tom's wife for asking. So Tom's second question, he writes, is the age-old question about paying down a mortgage versus investing. And Tom's given me sort of a brief overview of his circumstances. 38, 35s, let's call it mid-30s, one child under two, maybe some additional children in the future. Combined income of 400, so 200,000 each, he says. Combined super of 400,000, 60-40 invested in international and Aussie index, 50,000 of ETFs. Primary place of residence worth about 1.5 million with almost about $1 million worth of mortgage, just under. Investment property, 700,000 with a $250,000 mortgage. It was their previous home. It's not investment grade. And they're looking to upgrade the primary place of residence to a larger home with a larger land holding in a blue chip area. And they need to spend about 2.2 to do that. Tom says that they don't want to sell the existing home until they buy a new one because there's not any rush and they can't buy it subject to the sale because they're in Perth, too hot a market. They will likely sell the investment property in order to upgrade or use the bridging loan. Once the new home is purchased for 2.2, we will likely follow the following situation, or have the following situation, sorry. A $1.5 million mortgage on a $2.2 million property, 150 grand the offset, both maximizing concessional contributions, and approximately $20,000 a year surplus with the plan to pay this surplus into the offset account. On my calculations on the current budget, by the time I'm 60, we will have paid off the primary place of residence and have 2.9 million in combined super, hopefully a perpetual portfolio. My questions are, number one, should I reconsider selling my current principal place of residence, noting it's aging, it's not investment grade, and the house cannot easily be upgraded, renovated, and has a low mortgage, i.e. low tax deductions? Number two, once the primary place of residence is purchased, should I use my surplus in my budget to pay down my principal place of residence so it's paid off by retirement as planned? Or, assuming I've sold my current investment property, loan against my principal place of residence, essentially converting deductible to non-tax deductible debt, to purchase an investment grade asset, prioritizing the likely capital gains over paying down the loan. Sorry, Tom, I'm a bit confused because you say consider selling your primary place of residence. Yeah, I'm sorry, I don't understand the question. So let me just talk around it to try and pretend that maybe I do understand it a little bit. What would I do if I was in your situation, which is the key thing? Look, you bought your investment property. You said it's worth 700,000, you got a $250,000 mortgage. It's positively geared. You said it's not investment grade. You purchased it for 400,000. So you've made a little bit of a gain on it. I'd get rid of it. Just sell it. The whole thing is about trying to level up as much as possible on quality to do the upgrade. And if that's going to even retard your ability to either repay debt or maybe spend a little bit more on the upgraded house to make sure you don't compromise, well, may as well get rid of the property to give yourself the greatest scope possible to be able to execute on that. And also, like, if you have the property, it's positive cash flow. It's not really giving you any tax benefits. It's not a reason not to hang on to it. But, we wouldn't otherwise go and buy that property today, would we? I mean, if it's not investment grade, it is what it is. It's helped you. Just move it on and put that equity to better use. And the better use is, less debt on a primary place of residence in a good location that's going to earn tax-free capital growth. So I'd certainly sell that. Then the next question is, would you sell your current home? Assuming you could afford to hold on to it, would you keep your current home as an investment property? Look, it's worth 1.5 with about $1 million of gearing. So you've got enough gearing there, like it's going to work for you. But I don't know if it's going to give rise to kind of too much non-tax deductible debt. And a lot of non-tax deductible debt does really retard your ability to invest in other assets. So that is, you said you'll maximize concessional contributions. That's great. So you'll have plenty of super. And then because you've got such this big home loan, $1.5 million, as you said, you've done some projections, you'll spend the next few decades paying it down. And apart from super contributions, you don't have anything else to really do with your money. Whereas I reckon what I would do is I'd do the upgrade. You said you're going to spend 2.2, maybe, spend that or maybe a little bit more, sell the 2 existing properties. So then you're all into the upgraded family home. And then, as you said, borrow against the equity, buy an investment property. You've then got a lower non-tax deductible debt. So it's cash flow wise, you'll have a bit more flexibility. You'll have the investment property that should give you a little bit of tax relief, but also make sure you're going to benefit from that compounding capital growth just in case the super doesn't perform, as we hope it would perform over that long period of time, and then maximize super contributions. That's what I would do. The idea is, or the methodology typically is, buy property, never sell. And it's true to an extent, but, sometimes selling, reducing debt, and then replacing those assets, sometimes, in fact, that's a better way to go, not only from a wealth perspective, but also from a risk perspective. And, if you're going to really take on a lot of debt, you've got a lot of borrowings, you really want to be rewarded for it. So the only time I'm going to borrow to my eyeballs, let me put it that way, is if I'm absolutely certain I'm investing in fantastic quality assets. No point taking the risk to extend yourself and put your cash flow under pressure potentially, unless you're going to be rewarded for it. So I reckon sell the 2 assets, upgrade the home. Okay, next question is from Andy. What a fabulous resource you have provided to so many for so long. Easy to understand, thought-provoking, and occasionally humorous. Well, that's nice. I hope you get as much enjoyment out of it at your end. I very much do, as I answered the previous question. So thanks very much. And thanks for suggesting that I'm humorous, Andy. I'll certainly share that with my 2 sons, because they don't find any humor whatsoever in really anything I do. So it's good that at least someone else does. Okay, let's get into your question, Andy. Andy writes, structuring property ownership is something you've touched on several times. And I think my wife and I haven't quite nailed it on the head. I earn $350,000 and she has a side hustle that's getting off the ground, earning about $50,000 a year. She has no plans to return to full-time work as an accountant. Hates numbers, go figure. Yeah, well, pick the wrong profession. She has an investment apartment in Glen Huntly worth $350,000 that we will sell once Melbourne gets a bit of momentum. We can hold it for now and it's almost neutrally geared. This is solely in her name. We then have a 2-bed villa unit in Essendon that I thought I bought for a steal the day after the 2019 federal election for $630,000, only for it to flatline ever since. This is tenants in common, about 60-40 split, with me owning 60% as I came up with a deposit funded from shares that were owned pre-marriage. It's negatively geared about $400 per month, but has a high land to asset ratio and a good location will hold forever. We then had a primary place of residence in Yarraville bought in 2017 for $1.1 million, which is a good period home in a good location near the village. The tenants in common split is 40-60, this time in her favour due to coming up with a deposit from the sale of a Richmond property. We moved out in 2022 and it's now tenanted, negatively geared around $800 per month, but will hold forever. We did these splits in ownership to reflect each deposit contribution, acknowledging going forward interest payments are joint as we're married in combined finances. If we were to break up in the absence of a prenup, forget the document's correct name, that's right, prenup or postnup, binding financial agreement is what it's called, we would sell the property and split it as per the percentages. So my question is, at what threshold for which we should adjust ownership percentages to better capitalise on negative gearing off my higher income? Appreciate any change triggers costs, and this likely needs to be weighed up with the savings of negative gearing over long term. I've heard splits like 1 or 5% previously. What would this be used for? Okay, so thanks for the question, Andy. Andy's got a second part, unrelated part to his question, so I'll get to that in a second. Property ownership structure, obviously, we've got some property that was owned pre-marriage. Then Andy got married, and then they bought one property and put mostly in his name, and then another property mostly in her name, thinking about sort of deposits and these sorts of things. It's a bit hard, it's a bit difficult ownership. What I probably would have done, let's say if we go back to the Yarraville property, you bought it for 1.1, you went 40 in Andy's name, 60 in Andy's partner's name, due to her coming up with a deposit from the sale of a Richmond property. So what I probably would have done is still might have gone 50-50 and then just put the deposit in the offset account, so had kind of full gearing on it, if you like. And then you can move at least any monies in offset from her share into your share, depending on any changes in taxable income. So that's the way I like to use tenants in common ownership structure. So let me give you a really simple example. In fact, an example that I went through this week with a client, and it's very common. You might have, one spouse earning all the income, the other spouses stay at home, looking after kids, all that sort of stuff. In this situation, at 200,000, and let's keep the numbers really simple, buy $1 million property. So they got sort of 20% in cash and they need to borrow 80%. What I said in their situation is have the wife own, in this situation, the wife was a non-income earner, have the wife own 20%, use your cash to purchase that. And then the husband will own 80%. And of course, will go and borrow for that. But actually what you could do is you could have both of them borrow. The wife will borrow 200,000, put 200,000 in the offset account, no interest. She'll get 20% of the rental income, not paying you tax on that. And then the husband will get 80% of the rental income, but really 100% of the family's interest cost because he's the highest income earner's name. And then off we go. We might even do like 25-75, knowing that there'll be a little bit of gearing in the wife's name. But I guess what we're trying to do is find a nice balance that not only helps us certainly not compromise on negative gearing. That's the key thing. You don't want to do that. But also try and balance out capital gains tax as well, particularly if people go and sell these assets when they're retired. Hopefully both spouses don't have too much income. You don't want all the gain going into one person's name. So, but something as close to 50-50 tends to give you a little bit more flexibility, particularly if you're younger and your career could change and your income might be a little bit less predictable. And so that's why I try to get as close to 50-50 as possible. Now, you got 40-60 for a couple of different properties there, Andy. And I guess the way you can try and balance up tax benefits is by splitting out those loans so that you have your share. For example, let's talk about Yarraville, your share of 40% of the debt and maybe her share of 60% of the debt to sort of ownership percentages, and then offset her share first if you've got any cash savings. And so therefore you're shifting the interest deductions into your name. But it's not a perfect science because, there's lots of things can change over time. So this is another thing too. We don't want to get too tricky with it. We don't want to get too exact science with it. The only other thing I would do with property ownership sometimes is have like a 99-1 situation. So where I have one spouse own 1% and the other spouse own 99. I might do that again if they don't have any cash deposit and we've got a high income earner. One of the spouses is a very high income earner. Only reason I'm going to have the other spouse on title for 1% is really just an asset protection thing. If you were on title of a property, so you've got both spouses, for example, on title of a property, no one spouse can go and deal with that asset without the permission of the other spouse. And so in a relationship breakdown perspective, someone could get a bit angry and go and sell a property without any approval or, without going through the proper channels to do that. Well, they can't do that if both people are on title. And so that's just a bit of an asset protection thing to protect spouses if they're co-owning assets together. Okay, Andy's second unrelated question, maybe a full episode here on bonds and how they can fit in asset allocation. Why would anyone with a mortgage offset ever invest in bonds? Returns need to be quite a bit higher to offset any income tax earned. A lot of other investment literature frequently references they're an important part of the making up of a portfolio, but as they primarily spin off income with minimal growth, not sure how they'd fit into anyone's portfolio that has a mortgage. Okay, so first and foremost, Andy, the best way to invest any cash savings, if you don't want to put it into growth assets, is in a mortgage offset account, especially if that mortgage offset account is non-tax deductible, so it's against your home loan. But even if it's a investment mortgage account, you're essentially saving the interest rate on a risk-free basis. That's a guaranteed return, and there's not much out there in terms of guaranteed returns. And if you're offsetting non-tax deductible debt, home loan, it's an after-tax rate. It's an after-tax return, let's say 6%. Well, you've got to earn 9% plus to be better off. So certainly offset account, great way to park cash savings. And then what I would do is I would refer you to episode 310. The title of that episode is Should You Invest 100% of Your Super into Shares? And it's something that we've been reflecting on in our business. And in fact, I talked to every advisor in my business and asked them if they had bonds in their super, and they all said no. And so, we've got this theory out there to say, okay, invest in negatively correlated assets, and typically bonds are negatively correlated to shares, which means that when shares fall, bonds rise. And what you hope to do is smooth out portfolio returns and reduce the volatility in a portfolio. And that makes everyone feel good, having less volatility. And if you ever need to interrupt the investment strategy or investment cycle before it's, had enough time to sort of play out, and you've got a lower volatility portfolio, the chances of making a loss are low. Okay, so we get all that. That theory is correct. But yeah, why would you invest in bonds? If you're happy to wear volatility, if you're happy to stomach volatility, if you're happy to continue to focus on maximizing returns over the long run, so all you're worried about is making the best returns over the next decade, and who cares what happens over the next 2 or 3 months, then bonds probably shouldn't play a big role in your portfolio. But for those clients that get to an age and stage of life where capital preservation is more important than returns, they've got more money than they need, they just want to hang on to it, that's when you want to introduce more defensive assets. But, have a check out that episode 310 where I talk about a little bit more, but that's a general gist of it. Anyway, Andy finishes off with arguably the most important comment that he's written in. He says, thanks again. Hope the cats have a good year. Oh, no. Okay, I didn't even read the full sentence. Only to be beaten by the D's in the granny. Well, let's hope that doesn't happen. And that's the worst sentence I've actually read. So anyway, thanks, Andy. Okay, next question is from Adam. Adam writes, love the potty. Can't wait for it to drop every week. Thank you, Adam. My question relates to episode 346. And episode 346, the title was 4 Things an Advisor Can Do to Help You Boost Portfolio Returns. Anyway, so his question relates to that and companies and corporate beneficiaries of trusts, with the trusts also being a shareholder of the company. So what he's saying there is normally what we have is a trust and then a corporate beneficiary, which is just a company that's a beneficiary of the trust. But the shares in that company are owned by the family trust. So it's really a kind of circular relationship, if you like. You can distribute into the company can then pay a dividend out, and that goes back into the trust. Anyway, Adam's question says, my question is, if it's a testamentary trust with one of the beneficiaries being a company, can profits from the company get paid back into the testamentary trust and get the same tax benefits to minors as per the normal testamentary trust distributions? Or should the company have a different family trust as a shareholder? Well, actually, you couldn't have a company that could pay a dividend back into the testamentary trust, because the only way you could do that is if the testamentary trust was a shareholder of that company. But the company, it can't be a shareholder because the testamentary trust doesn't exist until date of death, until the will says that it exists after the death. So that's not going to work. Also, there's a couple of years ago, they clamped down on a little bit of a loophole that restricted capital contributions into a testamentary trust. You used to be able to put money into, once you had one, you could put more money into it. You can't do that anymore. So no, there's no way. If you've got a testamentary trust and it's got some capital in it, if you take that capital out of the testamentary trust, then you're going to have to live with that decision for, as long as you're alive. There's no way to reverse it. So you need to think really carefully about it. And what we've done for some clients is, instead of withdrawing the capital, which means really distributing the capital, the testamentary trust has loaned money. Because if we borrow the money from the testamentary trust, we can always repay it in the future. So the testamentary trust loans the money, they put it in their offset account, reduce their debt, whatever. In the future, when they're in a different financial position, they might want to put that money back in the testamentary trust and invest it again. So that's the way we kind of navigate that one. All right, a few interesting ones today, few curly ones, tax ones as well. So kind of interesting. I hope you enjoyed it as well. Might leave it there, I should say. And then until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.